This episode of Money for the Rest of Us is sponsored by a new podcast called Outside the Box. If you're a maker, a doer, an innovator, or even just a consumer who wants to get a peek behind the curtain of some of the world's greatest organizations, you should check it out. The first episode features conversations with presidents and CEOs from organizations like the World Wildlife Fund, Feeding America, and more. And you can expect new episodes about things like corporate culture in the 21st century and inventive approaches to business with great insight from some of the brightest minds in the nation. So subscribe now to Outside the Box in Apple Podcasts, Stitcher, or wherever you get your podcast. If you're looking to replace your air filter, there's no better option than FilterBuy. FilterBuy offers a wide selection of high-quality air filters in every MERV rating in over 500 different sizes, including custom sizing, so you're sure to find your filter for your HVAC unit, no matter its dimensions. Better yet, all orders ship free within the continental U.S. direct from FilterBuy's factory to you, so you get the best price possible. And now for a limited time, get 10% discount by going to filterbuy.com/David. That's filterbuy.com/David. Welcome to Money for the Rest of Us, a personal finance show on money, how it works, how to invest it, and how to live without worrying about it. I'm your host, David Stein, and today is a vacation special. It's a conversation I had with Michael Port of the podcast Steal the Show. I'm often asked by listeners or other podcasters, what's my process? Do I batch my episodes, or how do I go about that? And the fact is, I do not record more than one episode at once, and I do not have a backlog of episodes. I usually record an episode on Tuesday and release it on Wednesday, which usually works great, except if something comes up. And something came up. My mother-in-law, Marita, passed away last week, and the funeral and other activities were on Monday of Tuesday of this week. So I did not get an episode recorded, and so we're going to play and let you share with you the conversation I had with Michael Port. Michael Port's podcast, Steal the Show. He is a public speaker, author, and entrepreneur. He's written 6 books, including Book Yourself Solid and Steal the Show, the latter which, according to the former presidents of Starbucks, might be the most unique and practical book ever written on the topic of public speaking. Michael was a great interview. We had a wonderful conversation. We talked about running a business, being an entrepreneur, saving for retirement, our emotional relationship with money, asset allocation, minimalist investing, health insurance, health share ministries, robo-advisors, behavioral finance, and choosing a financial advisor. So it's a wide-ranging conversation. And I had a great time, and I appreciate Michael for letting me be on his show. So enjoy the interview. Just one other technical note. I'm not an audio engineer, and the sound level of this interview is a little higher right now than the actual intro to this week's show. So hopefully I'll get it fixed in post-production, but if not, go ahead, turn the volume down in your headset or on your car radio, so your ears don't get blown out. I apologize if I don't get this issue fixed, but I'm supposed to publish the show in less than 2 hours. Enjoy the interview.
Welcome to Steal the Show with Michael Port. This is Michael. Today's guest is David Stein, and he's the host of the podcast Money for the Rest of Us, which is a show that I listen to religiously. I think he is one of the best in the business at teaching personal finance for the rest of us. Over 25,000 listeners download his each episode of the show. It's all about how money works, how to invest it, and how to live without worrying about it. He also provides market insights, asset allocation help, and portfolio guidance to over 500 members of the Money for the Rest of Us Hub, an investment education platform. Previously, David was Chief Investment Strategist and Chief Portfolio Strategist at Fund Evaluation Group, which was a $50 billion, I stumbled over the word because it's such a big number. I don't usually say $50 billion institutional investment advisor. So that's what they did. And at FEG, David was co-head of the firm's 21-person research team that provides institutional research on private equity, real assets, hedge funds, equity, and fixed income, including topical level and manager-specific research. He was responsible for top-down research, including macroeconomic analysis, market sentiment research, portfolio modeling, and capital market analysis. And he also co-founded FEG's $2 billion asset management division. He developed its investment philosophy and process and acted as lead portfolio manager for over 9 years. Now, you're listening to all this and going, well, how the hell is this guy going to help me with personal finance? This stuff is so, way out in left field for the average person. But trust me, this is what he does. He really, really focuses on money for the rest of us. He just happens to have an extraordinary amount of experience in very, very large institutional investing and research as well. He's spoken at numerous investment-related conferences, including events sponsored by Morningstar, iShares, TD Ameritrade, and FinCon. So you can find more at moneyfortherestofus.net, moneyfortherestofus.net, or moneyfortherestofus.hub.com. So, without further ado. Hi, David.
Hey.
Okay, so I don't have too many guests on the show whose podcasts I listen to regularly, but yours is a favorite of mine. It's absolutely phenomenal.
Well, I really appreciate that.
I like to think I'm not prone to hyperbole, but I mean that. For me, over the last number of years, a big focus in my life has been studying personal finance because, of course, I made the mistake of getting serious about personal finance when I had some money. I thought, well, I don't have any money when I was younger, so that's not relevant. And I thought, well, there's a man in a suit. He knows what to do, and he'll tell me what to do, and that's not always the case.
No, you learn that the men in the suit or the women, most don't know what they're doing.
Exactly.
Even though they're collecting fees to do that.
Exactly. So I want to touch on that in a little bit, but one of the things I'd love to do right off the bat is learn a little bit about the mistakes that you made with respect to your personal finance early on in your life.
Well, I made a lot of the same mistakes, and it's really everyone has an investment journey, and so we had some early credit card debt that many people have. I started out. Most people's introduction to finance, they find a stock that they're interested in or a company, and they buy stocks. And so I've made mistakes buying stocks, realizing that I don't have any type of informational edge when it comes to buying stocks because the stock market, it's an auction market. So when you're buying a stock, somebody is selling it to you. And unless you know more than the people on the other side of the trade, most of the time you're not gonna win. You're not gonna outperform the market. And so, I didn't make any sort of huge mistakes. It's just small mistakes you make over time as you learn, and you find the way that you're most comfortable investing.
Were you a saver from day one? Was that always part of your DNA?
Not really. No. I mean, I knew I was supposed to save, but we grew up in a pretty poor family, and so there was not a lot of savings. And so coming out of that experience, there was definitely a knowledge, knowing I needed to save, but no, I over time, and you see this with a lot of people that end up retiring early. It isn't so much their savings percentage; it comes from income. In other words, their income grows. They find a way to be creative to increase their income, and then they can save the 15 to 20% or more that most people need today, especially with investment returns so low. The target should be 20%. If you want to retire at a normal age, if you retire early, you're going to have to save much more than 20%. And I admit that takes discipline.
A lot of my listeners have their own businesses. And, sometimes in the early days, your financial situation can be anxiety provoking. And especially for those who are young, you did an episode on the American dream and, asking, is the American dream dead? And just today in the Wall Street Journal, maybe you saw it, there's an article about the percentage of young Americans living with their parents has risen to a 75-year high. And that means 40% of young Americans are living with their parents.
That's amazing.
That's extraordinary. So, even though the economy has rebounded, to a decent degree, and the job market is better than it has been. If we need to increase our income in order to save more substantially, do you think that being a business owner will give you an advantage over being an employee, or vice versa?
Oh, absolutely. And I did an episode on how you're not going to get rich investing. You very, very few people have gotten rich investing. Most have gotten rich through their own businesses. Even in the investment space, hedge funds, they're getting rich collecting fees from their hedge fund business, not necessarily always from the returns itself. Now, so generally speaking, yeah, I think that individuals, if they have the willingness, should start their business, be it a side project or something. It's an incredible world out there right now where we can leverage technology, leverage the tools that we couldn't access before. And so you can start business on a shoestring and just start connecting with people and find out what they need that you have an interest and a talent to provide.
Not all. There's, it's interesting. The word entrepreneurship is thrown around a lot, but often when folks start a business, they're not actually starting an entrepreneurial venture. They're starting a business, or they're starting a practice. If you open, a mom and pop type shop in your neighborhood, you're probably a business owner rather than an entrepreneur. If you start a service-based business, you're a practice, and maybe you can turn that into a scalable, leveraged type business that is saleable. But certain businesses are certain types of businesses offer more opportunity for sale than other businesses. And from day one, I've been doing this kind of work for 15 years, writing books and speaking and teaching, and I knew that the business was really the retirement vehicle. That's how I thought about it, because a lot of, a great aspect of my business is based on my personal brand. And so it's a little harder to sell that kind of business than, say, Twitter, where most people wouldn't even know who started Twitter. And
right.
Yeah. So I guess I'm just saying, I'd love you to address how you think about using your business as a retirement vehicle, because I know that the income generated by the business is designed to produce a retirement, not necessarily focusing on designing the business so I can sell it. Does that make sense?
Exactly. And yeah. I think that that's a very important component. For example, my business right now, it's unsellable because the business is me. And I suspect yours is similar. The business is you, but then by leveraging your talent, you can create the income and save from that and not necessarily have a sale at the end. Most people won't necessarily have a business that they can sell at the end of their life, but it's creating the income stream for doing something you enjoy doing, but that creates enough income stream that you can save that 20%. And even if some people love being employees, but when we saw in the investment business that I ran, it was pretty clear which employees were showing initiative and wanted to just not sit and focus on the widget. They wanted to find ways to improve the business. And those individuals naturally rose in the organization. And you can do that as an employee, or you can do it as an entrepreneur. You just got to find the right match, because some people don't want to build a big organization. They just want to do their thing. And the key is to find a way to not be a commodity in doing that thing so that you can demand premium fees for doing the thing you want to do.
Yeah. And what's wonderful is that the retirement vehicles that are available to business owners are great. They are much more productive than the retirement vehicles that are offered to employees. Unless you're at a company that is very unusual and offering you a defined benefit plan of some significance that they're contributing to, which we do here. I'm very proud of. But, most individuals can't use the types of retirement vehicles that small business owners can. So it would really be a great idea for them to focus, learn more about what's available to them in terms of tax-deferred investing. And it's something that often they don't think about until later on, when hopefully the business is done very well. But if they think about it earlier on, they may benefit. So let's, speaking of improvement, you talked about improvement. How do you improve your emotional relationship with money? I mean, some people hoard it. They will not spend it. And they won't even invest it because, the markets scare them. And other people won't save at all. So,
well, yeah, that's a great question. I think it just comes from being honest with yourselves. And sometimes it requires counseling, right? If you've had a tough relationship with money or money was just not something you ever talked about growing up, or it was this undiscussable topic. Sometimes we have a lot of money baggage, but I think the first step is just to be open about it and talk about it and think about it and realize that money is not the end all of living, right? Money flows in, money flows out. We have to understand some basics of investing, but we don't have to be the ultimate expert when it comes to money. We just have to understand some basic building blocks, and everybody can learn how to put together a diversified portfolio of ETFs and not spend all this time worrying about it. So there's a basic level of education, and then and save, but just don't stress over it so much. And it takes a while to get there. But you recognize, especially if you, and I'm sure you have traveled overseas, you see what real money stress looks like. Yeah. In terms of the vast majority of the people have very, very little money in the world and hardly enough to meet their needs. And even in the U.S., I was shocked by this. The bottom 50% of the U.S. population, on average, is bringing home $16,000 per year. That's not a lot of money. And granted, that causes stress.
That's unbelievable.
But for the vast majority of your audience, and I suspect my audience, they have enough money. The question is managing it and emotionally learning how to handle it. But it's not the type of stress you have when there's no money at all.
Well, let me ask you the $64,000 question, which I imagine you've been asked many times. How do you get people to invest when they think they don't have enough money? I can think of one person in particular I was talking to who has a practice, and her client list is a little smaller than it has been in the past, but she's still making money, and she's still buying expensive things, but she doesn't feel like she has enough money to put away. How do you get them to do it? How do you make that connection? Because for me, it was this idea. For me, it was my family and what I wanted to do once I stopped working. Like, at the beginning, I was really, you did an episode about working to live or living to work. I was really deep into that cult of overwork, and I was loving what I was doing, and I still do, but I don't want to do it forever. So my vision became much more clear about what I wanted to do, and that helped. Is there anything else we can do to get people to put away even just a little bit? I mean, even just the act of putting away, say, $50 a month is going to change the way you start to think about money.
Well, I think it does. And what's amazing is there's tools to be able to do that. I mean, it used to be very difficult to invest in the stock market. The brokers charged $40 a trade. Well, if you're only putting $100, you can't be paying $40 in commissions. And so now there's apps out there. M1 Finance is one. There's others out there where you can start an account for $100, and they don't charge commission. They just charge a small annual fee. And so you can actually, there's tools to do that, and the roboadvisors out there. So you just start getting in that habit and automate it as much as possible. So it's just coming out. And what I have found is once people start to have a little bit of savings, then they become more interested in terms of learning how to invest it. But I think in your case, right? It was your vision of what life could be like 20 to 30 years ahead, and realizing that you wanted a different vision. You didn't necessarily want to be working 80 hours a week. And most people, the reality is today, they haven't saved enough for retirement. And so in their case, they need to figure out a plan, obviously keep saving, but how can they sustain a comfortable life, perhaps as a side project, lifestyle business or something that they can continue to work until 60s or 70s, because that's just the reality of the numbers. And I think as more people, I was at a McDonald's the other day and buying breakfast, and the back kitchen staff, I think the average age was probably 70 in the back. And I think, as we see more and more of that,
we do.
That can be a motivation for people to start saving more and learn some basic financial education when you're in your 40s or 50s or 30s.
Yeah, we are seeing that a lot, aren't we? I often feel bad, that somebody who is my senior like that is waiting on me and, doing remedial work when they may have done more advanced work earlier on in their careers, but they had to retire from that. And now they, need the money. And that's got to be tough. Actually, even it's sort of a side story, but one of my good friends growing up, his parents were both doctors and had done very, very well and had retired, and they had a good percentage of their retirement money locked up with Bernie Madoff.
Oh, wow.
And they both had to go back to work at about 75 years old.
Yeah, that's tough, which goes back to that basic education. In fact, there was a, and I'm not saying that they were at fault. I mean, you never know, but one thing you learn from, everyone should have learned from Bernie Madoff, and just recently, I think just this week, there was another firm, Platinum Partners or something, was the same situation. And, part of learning to invest, and that's why you start out buying one stock, and you realize markets are really volatile. They go up and down. And so if somebody's coming and saying, I've made 15% a year and never lost money, you just
say no.
You start questioning.
Yeah,
It's just like there's something wrong here. But if you've never invested, you don't know that. You think, well, there is some genius that can do that.
Sure.
And you realize there are very, very few geniuses, if any, when it comes to investing.
Well, it leads to my question about trusting the markets. When Wall Street is generally, and I try to stay away from generalizations because all generalities are false, including that one. But I'd say generally many financial advisors and many on Wall Street are not trustworthy. And that's at least how people feel. So how do we engage fully in, say, investing in the markets when we don't trust the systemic behavior of Wall Street? How do we sort of balance those two thoughts in our mind that, the stock market historically over time has been a very effective way to produce generous compound returns. Yet we have these people who are very involved in the market who are making some really often very bad decisions and blowing up the market.
Well, I think there's a balance there. One, individuals should have as many different return drivers in their portfolio. So you diversify as much as possible. So diversification, many eggs in many baskets. You're also diversifying fraud, right? So you're not. I mean, there are unscrupulous investors, but generally speaking, the market itself. I mean, there's people that still, there's been issues with fixing of interest rates and stuff, but most of the major fraud gets found out eventually, and it's not like it cost an individual a huge percent. Maybe it was pennies in terms of it, and it's sad. But we have to be willing to invest, which means in learning about asset classes, learning how what an ETF is, or an exchange traded fund, and stocks. But you kind of have to focus on what you can learn, and just have, essentially to just start with the basics is the way to do it, and trust that fraud will be found out, but you just got to invest. And that's when it comes down to it. Yeah. And it's hard. It's hard.
Well, there's so many different investing products out there that it can be very, very overwhelming. I mean, even for newer folks, and sometimes even people who've been doing it for a while, the concept of diversification can seem complicated or overwhelming. Well, diversification means a lot of different things, and I got to learn a lot of different things, and that can be overwhelming. There are insurance products that are often bundled with so-called investment products, and they're pitched very hard. And then there are all sorts of different actively managed funds which are pitched very hard. And
that's where exactly, which was why the place to start. You start with asset classes and index funds or exchange traded funds, and just figure out, all right, here's how much I want to put in stocks. Here's how much I'm going to put in bonds. So not investing in individual stocks takes away half the work, right? Because suddenly you don't have to worry about what Apple is doing versus IBM. And it's sometimes it's fun to play with that on the side. But if you're saving for retirement, you can just avoid that whole area and focus on just the basic, keeping fees as low as possible. Don't buy insurance products tied to investment products, because the assumption there is somehow the insurance company is a better investor than everybody else, and they're not. And so people should protect against the downside, so have some term insurance, but most people don't have to deal with insurance investment products. They don't have to deal with active management products. They don't have to deal with buying individual stocks. Focus on the building blocks, which is asset classes, and learning what drives the return for stocks over time, and just some of the basic education that you can find through podcasts and other means, and start there. Eventually you want to start adding what I call pockets of independence outside of the financial markets. So maybe you have some food storage, some gold, or other issues. You might hear the dog. My dog is wailing in the background.
That's okay. As long as he's okay, he didn't get hurt or anything. It's not that kind of wail, is it?
It's a Shih Tzu. She expresses displeasure by acting like she's being murdered. It's the most bizarrest thing.
I know some people like that. So is this what you are, when you're referring to minimalist investing, you did an episode on that. Is this the concept that you're referring to?
Exactly.
Yeah.
Right. And an example. So I had somebody, and I did a webinar a while ago, and generally beginning investors, and her first question was about currency. Should I be buying this currency position? And I said, it doesn't matter. Don't worry about that. But that's often the introduction of people, because there's so many people out selling stuff. Their first introduction to investing is suddenly they want to trade currencies. Well, trading is not investing. And so a minimalist investor, right, they want to keep it as simple as possible. You can build a diversified portfolio of 6 to 8 ETFs. And for most people, and the beauty of investing in the early years, it doesn't really matter how you invest. What matters is how much you're saving. It's only later, after you've spent time learning and making mistakes investing, your portfolio gets big enough that the actual return starts to make more of a difference than the money being put in each and every year. And so there's times to make the mistakes when it's young and you're learning, and you can try different things. But if you're somebody that doesn't really like investing and it sounds too complicated, you keep it simple and you focus on the basic building blocks, which is asset classes, index funds, ETFs, and keeping your fees low, and people can retire that way.
Yeah, it's interesting. I was an artist when I was young. I was an actor, so I saw myself. I didn't see myself as somebody who was a numbers person. I still have trouble with math. My wife does all the math for us, and yet here I am feeling very, very confident about the way that I manage our finances and our investing. And my friends growing up, my best friends, most of them went to business school and then on to Wall Street. They run hedge funds. They're analysts. And, when I sit and we talk about this stuff, I sometimes feel like I actually am a much better investor than they are. And I know about 1/1000th of what they know about the markets. Because they...
Exactly, because they're very niche. In fact, I had a call yesterday at somebody that retired from a hedge fund, and suddenly now he's focusing on his own portfolio, and he realizes, well, this is actually a little different. Because I used to be an investment manager, and it's much easier investing other people's money, particularly institutions, because they're not as personally involved in it. But the skills in investing your own retirement is completely different than running a hedge fund or something, an institutional investment advisor. And so it is a different skill set. So you're right. You have learned. And the other thing you have is you're humble, right?
Yeah, I know so little that I will not do stupid things anymore. I mean,
well, right.
Yeah, it's knowing it's this feeling of real comfort knowing that it's okay not to know everything, but you know what you need to know, and that's it.
Exactly. And when I left the investment business, I went to Mexico for a week, and I was on the beach just writing, and I was answering what I called the terrifying question: how would I invest if I didn't have a clue what was going to happen next, but everybody else was investing like they did? And that's the world we sort of live in, where you have Wall Street and you have all these institutions that think they know what's going to happen, but they really don't. But and I think they believe they know what to happen. Some, if they're honest, say they don't really know, but people pay them to act like they know. But if we don't know what's going to happen, well, that's actually a strategic advantage we have, because then we can invest knowing we don't know what's going to happen. So that takes out a vast majority of the investments we just don't have to deal with. And so then we are investing in a way, as I mentioned, that where we can protect against the downside. In other words, we're not going to be 58 or 60 and have 100% of our investments in stocks because we believe stocks will always outperform bonds, because we know that's not the case. We can have 60% drawdowns in stocks. And if that happens, that can royally mess up somebody's retirement plans. And so it's a completely different mindset that everyone can learn, and recognizing nobody knows what's going to happen. And so if you invest knowing nobody really knows, well, then you're going to be way more diversified and perhaps take a little less risk than conventional wisdom and make it up by hopefully generating income in some other way and saving more.
Speaking of predictions going wrong, we just came through an election cycle that surprised many people. We have a president who wasn't expected to win. And as a result, there's a lot of uncertainty in the world, not just the markets, but in the world. And interest rates are rising for a number of different reasons, not just because we have a different president who's going to have a different economic policy, but we do know now that interest rates will be rising. What should people do about that, if anything?
Well, first off, we don't know interest rates are going to be rising.
But didn't the Fed just say we're going to be raising three times?
They said that they're going to raise their short-term policy rate. But that does not necessarily mean that longer-term rates are going to rise.
Oh, good. So could you explain that? Because that's something that clearly I didn't understand. So maybe some other people don't understand that. What's the relationship between the short-term and the long-term rates?
Well, I mean, there's some relationship. So you have the short-term rates that the Fed is setting. So, but it's like a 30-day rate. So it's a very, very short-term rate. They don't control the long-term rates. But longer-term rates are, let's say a 10-year rate is actually made up of a series of short-term rates, right? In other words, if you could buy a 10-year bond or you could buy a 30-day bond or fixed income instrument and just roll it over every 30 days. And so there is, some relationship, but it's not exact because interest rates are also driven by investor fear and greed. And so you have that whole people aspect to investing. And so it isn't a straight relationship from what the Fed is doing versus what actually happens with long-term rates. And so, and there's one, interest rates aren't predictable in that aspect because there's so many things that determine global forces. For example, so even though the Fed is raising interest rates, we also have higher rates in the U.S. versus Europe, the U.K., and other areas. And so money will flow to wherever you can get the most attractive return, and that kind of puts a ceiling on U.S. rates. And so ultimately, we don't know where interest rates are going to go. Now, the thing I like about math or about bonds and fixed income, and I teach, is it is more math driven in terms of you can estimate what your return is going to be if you invest in bonds. But generally speaking, man, that's kind of how the rates work. Now, I forgot what your actual question was.
Well, in
terms of that led up to where you said interest rates are definitely going to rise.
Well, yeah. So let's say if interest rates rise, and we've seen some of this already in the housing market, is there anything that we should do to prepare or make different decisions with respect to our investing? Because interest rates affect home buying, it affects car buying, it affects investing, and many other vehicles. So is there anything that we should do to prepare for that?
Well, in terms of, obviously, if somebody is buying a house or the rate's really high, we are at historical low interest rates, right? We're not at the bottom, but generally speaking, you should refinance. Or if you want, rates, the odds are rates will go up. We don't know if that's going to happen, but they will go up. But the good thing is, the main reason they're going up is because the economy is getting better globally. And so, there's been a lot of fear, well, rates go up, the stock market's going to tank. That's not necessarily the case, because if rates are going up and they're going up slowly as they have been, it's usually because the economy is doing better, which can help corporate profits, which can help other asset classes. And so people have been worried about rising rates for 3 or 4 years now. And your behavior of investors shouldn't necessarily have been any different, right? They should still have had multiple portfolio drivers in their portfolio. They should have had some bonds. They should have had some stocks and other asset classes, and they would have been perfectly fine and not be overly fearful about rising rates, because just because rates rise doesn't necessarily mean it's going to be a disaster in terms of the economy or the markets.
Now, one of the things we have seen rise, and I've seen it rise significantly, in my case, is health insurance. And many of the people, I should say, who listen to this podcast have their own businesses of one kind or another. And so they've got to deal with health insurance themselves. They got to buy their own plans. My plan for my wife, my son, and I was $1,500 and change last year. And for 2017, it's $2,200 and change. And that's
per month, right?
Oh, per month. Yeah, of course. And that would be great if it was per year. And that, it's a PPO, so it's supposedly the best platinum plan you can get. But I still pay $40 to see a doctor who is not in network. And most of the doctors that I see just happen to not be in network because so many doctors are not taking the insurance anymore. So you did an episode where you addressed insurance. Do you have some thoughts on how we can keep our costs under control, given that premiums seem to be going up? The insurance companies are often leaving states altogether, so you have fewer choices, and prescriptions, the cost of prescriptions are going up as well.
Well, it's flawed. I did an episode because I had the same experience. My insurance premiums were going to go up 50%. And your first thought is, I'm mad at the insurance company. Why are they ripping me off? And so I researched it, and this was a Blue Cross in Idaho, and turns out, no, they're actually losing money. Well, how is it they're having to raise rates 50% and they're still losing money? And as you start, there are many different influences, but the ones that I settled on in that particular episode was the pharmaceuticals. And not generics, but and you've seen instances of this with the allergy medicine where the pharmaceutical companies essentially have monopoly pricing power when they bring a new drug to market, where they can price. I mean, they bring a new cancer drug to market. Their decision on how much to price it, and they've readily admitted this, is how high can they charge without people screaming too much, either politicians, et cetera. So they have that's the primary driver. It's these pharmaceutical costs, and there needs to be, I'm not saying a price ceiling, but there needs to be a more, you can't have monopoly power in any economy and have it work well. And so it's not as simple as repeal Obamacare. That's not going to solve the problem, because there's only 11 million people on Obamacare, and 8 million get some type of subsidy. But the reality is it's going to have to be a systematic solution, perhaps market-driven, and perhaps even Trump suggested allowing insurance companies to sell across states as opposed to every state have their own little plan. But I don't have, to be honest, I don't have the total answer. I just know that that's one issue that needs to be addressed somehow, and in terms of some market solution so you just don't have that monopoly power, because it's a huge, huge driver of cost. Do you,
in your own case, do you buy high deductible or low deductible plans? And if you do low deductible or high deductible plans, do you also use an HSA, or similar vehicle for savings? What's the path that you took?
Well, I used to just pay it. And what I ended up doing in 2017 is, one, I had a PPO, right, which was nice because we like to travel. And you can, even though the PPO, the out-of-pocket deductible was reasonable. Well, this year, the Blue Cross divided up the state into these little pockets, and like really little pockets. So likely your hospital wasn't even on there. And if you went out of it, the deductible was $150,000. And so we had used high deductible plans. It was like a $10,000 family deductible, and it worked fine. I mean, I set up an HSA, but I just didn't like the paperwork, honestly. So I just put the money in there and just paid our expenses. This year, we ended up doing something I hadn't even heard of 2 months ago called a health share, which is essentially a co-op for health insurance that you don't have to pay the Obamacare penalty. They've been around for decades, and basically you pay a premium, but they call it a share, and it works just like health insurance, but your healthcare costs get paid by other members. And I was a little apprehensive about that, but they've been around a long time, and it brought the cost of what it was going to be $1,500 per, for the Blue Cross plan, and we're down to about $500 to $600 now per month with a lower deductible,
which is extraordinary. So, is this one of those Christian ministry type plans?
It was, right. And so, I mean, you have to, but it's not. It wasn't a situation where there was a huge litmus test.
Yeah,
it was agree to live a healthy life, agree to help other people with their health insurance costs, and a belief in God. I mean, that was, so it wasn't. Yeah. Most people probably could.
Yeah. I read about this recently because I was talking to an insurance broker trying to, look at what my options were. And he's like, listen, there really aren't any good options. Like, I can't get you anything that's going to make you happy, but there are these plans that are popping up. And he said, obviously I have nothing to do with them, but go check them out. And when I read the site for one of them, and I was a little skeptical, and it wasn't very clear. Well, how much do they cover? It was. I think they needed a little bit of help on their maybe on the marketing side.
Well, it could be right. I mean, the one we're in is Liberty. I think they cover $1 million, and in my mind, I mean, I joined assuming this is a year or two, perhaps, until they resolve the healthcare. Hopefully resolve the healthcare issue in terms of premiums. And
you're very optimistic. they'll solve it in a year or two.
I'm generally an optimist, but maybe it'll be a long term. And I was skeptical too, and I a little trepidatious. But I've talked to. Once you start asking around, you realize, well, there's actually a lot of people, particularly in the personal finance, blogging, podcasting space, that they've been doing it for years. Yeah. And it's like, well, I'm willing to try it out, and we'll see. And it's not. I mean, it works just like you got a little insurance card or a little card, and you give it to your doctor, and they bill Liberty, and they negotiate rates, which was one of the big benefits of insurance companies. Is at least they had agreed upon rates, so it often got knocked down in terms of it's just a flawed market. Yeah, we could go all day discussing it, but sure. We'll see how it comes out.
How do you feel about robo-advisors?
I think they're a great place for beginning investors to start. I did an episode where I answered all the questionnaires. So there was 7 or 8 robo-advisors. I answered the questions the same and found that their recommended portfolios were all over the place. And what a robo-advisor won't ever do is tell you what you can earn investing. They're not a financial planner. They will let you answer 3 questions or 4, and they'll say, here's a mix. And it's a diversified mix of exchange-traded funds. The fees are reasonable. The benefit of robo-advisors is technology, be able to move money in and out. But I don't think individuals should rely on robo-advisors as their primary savings vehicle throughout their life. I think people should get a little more education on investing than that. But they're a solution, particularly for newer investors. They've done a great job in bringing in a lot of individuals that had never invested before. But once you're there, you kind of have to go beyond that.
I'm not sure why someone would choose, even if they're just starting out, choose a robo-advisor, especially if they're investing in tax-deferred accounts, when they can just call up Vanguard, do a little bit of paperwork, open an account there, and even just use a total world fund, or a retirement, date type fund. Or, even maybe they're ready to do a 3-fund portfolio or something. But, it seems like that's just as easy. You're not going to necessarily get better returns because of this robo-advisor, and you're still going to pay lower expense ratios at a place like Vanguard. So that's one of the reasons when they're popping up for newer, younger investors, I kind of go, well, is it because it seems cool and sexy and that there's some smart algorithm on the back end that is going to know something, just like, the smart man in the suit. Well, he knows something that I don't know because that's what he does. Just the same. So, well, there's an algorithm that is going to figure this out because computers are really smart. And they're going to be smarter than me, so I should give them the money. No. Do you know, like is that what people are thinking?
But see, you're already more educated than most beginning investors, right? The idea of opening a brokerage account for most beginning investors that is completely daunting. I mean, I actually did a series. I walked people through the steps of opening an account, and so with a robo-advisor, the app, sometimes it just seems easier. But I agree with you. And I took a deep dive when robo-advisors first came out because we had sort of done something similar. And they had really slick technology, but it was almost like the investing was an afterthought, right? So they don't have this smart – they basically put together a diversified portfolio of ETFs. So it's not like it's a smart algorithm. It's a really cool, slick interface that – can help people get started. But I agree with most people are better served opening an account at Vanguard or Schwab or Fidelity and learning how to invest and not rely on somebody else. And that can protect you down the road so you don't become susceptible to somebody unscrupulous. Not that the robo-advisors are unscrupulous. I mean, they're building organizations, but there's better ways.
Okay, couple more questions, and then I'll let you go. Number one, what books do you recommend for newer investors, and what books do you recommend for a little more seasoned investors?
I wish I had my list of what I'll do is I'll give you a link that you can put in the show notes of all the books I've read in the past decade, and include some investing books. there's not actually that many great investment books out there. For more seasoned investor, I've read a lot by Nassim Nicholas Taleb.
Mm-hmm.
Anti-Fragile, I think, is a great book that helps you realize how unpredictable the world is. Something a little more simpler is the book that just came out by Michael Lewis. In fact, my episode that I'm releasing this week is on that, The Undoing Project, where he profiles Daniel Kahneman and Amos Tversky, and they were sort of the founders of behavioral finance, and how we as humans are flawed when comes to our decision making and our predictions. And it's a great book to sort of kind of introduce people to this concept that there's some specific things we need to do as investors to overcome flaws that we have. And an example is this whole Trump administration coming to office. I've gotten emails from people that are convinced to their core that the economy and the markets are going to crash when Trump takes office after he starts doing whatever he does. And you realize that is, we use what's called the availability heuristic. We are coming up with a mental model in our mind. This is all subconsciously. And it's the first one we could come to. And we saw this after the Great Recession. For years after the Great Recession, any economic data, there was always the pundits, and many were saying the next shoe is about to drop. The next recession is imminent, because what happens is we tend to remember the worst thing that happened. That's the first thing that comes to our mind. And people are convinced that that's what Trump is going to be. And so we shouldn't be selling our stocks because Trump's coming to office, because we don't know if he's going to be a good president or a bad president. Nobody knows that. The way we should be making a decision is our regret. If he turns out to be a bad president and the economy tanks and the market falls, how will we feel if we didn't make changes to our portfolio to reduce risk? Versus, how will we feel if we actually made changes and sold our stocks and the market went up another 100%? These are risk aversion decisions that we need to make. In other words, what is the risk? What is the regret premium, as Lewis describes it? How much regret in terms of give up of future returns are we willing to take to avoid a 60% loss in stocks? That's what people should be focusing on, not predicting what's going to happen when whoever gets into office. And so this particular book talks about that. It's a great book from that aspect.
Do you have any favorite podcast episodes that you've done? Like that you would recommend? It's like, oh, these were my favorite ones. Because I know I have a couple that are my faves. My favorite is always the last one I did right now, because I just listened to it this week. I run a solo show, so I don't do interviews. And so I listen to my podcast a lot. Sometimes I listen to old episodes because, like, really? I mean, I learned stuff from myself. I don't know if you do this, but I learned stuff from myself that I said a year ago. It's like, oh, yeah. So, but this one that just is going to be released, probably will get released before this episode, so released toward the end of December, on should you sell your stocks before Trump enters office. I mean, that's I think is an important episode. The episode on healthcare. But the way my show is set up, it's not just plain vanilla nuts and bolts investing in the economy. It's teaching people what is money, how it works, how to invest, but more importantly, how to live without worrying about it. So there is a lot of philosophy involved, a lot of storytelling, narrative driven, because I use the podcast as a way to learn. I'm in it, you're in it, just like everyone else. We're all trying to figure this out. And that's why I love podcasting, for just as a way that we can all learn together. One of the big takeaway for me from your podcast over time has been how to think about money. And that's to me worth more than any highly technical type of show or episode, with respect to what to do with the, small cap value or whatever. It's if we, learning how to think about finance and put it into the context of everyday living has been so valuable to me. And I think that's the theme that I take away from your show overall, is the learning how to think about it. Because once you learn how to think about it, then you can study properly and appropriately and make good, sound decisions. And when you don't know something, then you can search out the answers because you have a context for them.
Well, I agree, and that's why I don't do a trade of the week show at all. This is not. This is evergreen content, and so many listeners will listen to all 138 episodes because they do build, and they build because I'm learning as I go, and finding better ways to express my philosophy of money and how people can make it through a world that is becoming increasingly more complex, and so that's just the way it is. So I encourage people to listen and give it a try. But the thing that I love about podcasting is, there's people that you got to find what I call in investing, you need a virtual mentors. And so many of the people that taught me the most about investing, Seth Klarman and others, I've only met a couple times or I haven't met at all, but I've sort of liked the way they think and I've learned from them. And it's the same with podcasting. There's some great podcasters out there. Joshua Sheets, for example, does Radical Personal Finance. He is the smartest financial planner I know, but he has a view of the world, and he has people that he teaches. And there's many others that you can just kind of have to find just kind of your virtual mentor that can teach you about these concepts, not just in investing, but in other areas.
Yeah, you know what I'll do? The founder of FinCon sent me a list of his favorite podcasts on finance. So I'll share that with this episode as well.
All right, Philip Taylor. And Philip Taylor's he's coming out with a podcast here in a couple months, and he's also would be very, very good.
He would. And of course, yours I recommend first and foremost. Okay, last question. How can the average person who is not financially educated or only has a little bit of financial education, how can they determine whether or not someone truly has their best interests in mind? Because this designation of fiduciary is not always adhered to. And frankly, if a fiduciary gives you paperwork that says sometimes I'll make a decision that's actually not in your best interest, they can get away with it. So how do you determine whether or not someone who is offering you their help has your best interests in mind?
Well, first I'll see how they're compensated. If there's a commission involved, then they don't necessarily have a fiduciary duty to bring the best ideas to the table. And so I think getting financial help is important. But I believe it's better to pay somebody a fee for their time on a project basis. And that would be a first place to start. Don't pay somebody to manage your money if you can avoid it. Because first off, a financial planner is going to charge 1% or more. And in a world where interest rates for bonds are 2 to 3% and stocks potentially will only earn 6 to 7%, that's a huge chunk of money that you're paying somebody that's going to do exactly what you could do if you just spent a little bit of time in building out a diversified portfolio. So meet with a financial planner, have them do a financial plan, even if it costs a couple $1,000s for the project, and then go implement it yourself. There's nobody out there smart enough that's going to do it better than you. There is not a genius out there. Most of us as individuals, I mentioned Seth Klarman, right? He is the smartest investor I know, and he's generated 18% annualized returns. But his fund's been closed to new investors for over a decade. So you can't find people like that. And most financial planners, they're good at putting together financial plans. They're not investors. And so understand what the compensation is. Pay people up front for the work that they do, and don't do it through a commission, because that's where it becomes an issue. When it comes to insurance products, buy the plain vanilla disability insurance and term life insurance. Don't buy these index universal lives, whole life, because once we start combining insurance with investment vehicles, then it gets really, really complicated and very difficult to find out. So you just keep it as simple as possible.
And if a financial advisor is advising you to do something and you can't understand what they're saying, it's likely they don't know what they're saying. And that's a great sign right there.
Well, right.
Yeah.
You should be able to understand. Nobody has this magic formula that, and because I spent many years, part of our business was trying to find the best investors in the world. And you realize there's very, very few. And most products are too complicated. And Wall Street likes to have the flavor of the month, so you get these things that they're always pushing. And so, but for most individuals, it's index funds, it's low fees, it's diversifying as much as possible. Learn how asset classes work in terms of stocks, bonds, et cetera. And you can do it. You can open an account at Vanguard and put it together and focus more on generating more income and having a successful life that you enjoy and saving.
Many folks that I've talked to who've been studying personal finance tell me about a pivotal moment that really opened their eyes to what was possible for them and changed the way they saw the world. For me, that was a conversation with my father-in-law. And if a listener hasn't had that experience yet with somebody, hopefully this episode or maybe another episode of your show that they listen to, or maybe if they join Money for the Rest of Us Hub, then maybe they'll have that experience too. And then forever, more, the world will be different to you. You'll really see the world in a different way. And I think ultimately a much bigger way, because you'll see that you have options and you'll see what's possible for you. So thank you so much, David. I really appreciate your time. Again, moneyfortherestofus.com and moneyfortherestofus.hub.com is a community of folks. I'm not in there, so and I have no personal interest or conflict of interest when sharing David's sites. But that's a community of folks that you're teaching personal investing to. From the way I understand it. Great. Okay.
Yeah, that's right.
Okay, cool.
Thanks,
yeah.
Michael.
So again, thank you so much. And everybody, keep thinking big about who you are and what you offer the world. It's a pleasure to serve you. I never take it for granted. I know my guests don't either. It is an honor to have your ear for this time, and we'll keep doing our best always. Until next time. Bye for now.
So that's my conversation with Michael. Just to note, the website for Money for the Rest of Us is moneyfortherestofus.com. So moneyfortherestofus.net, moneyfortherestofus.hub.com have been consolidated into moneyfortherestofus.com. So you can find information on the hub, now called Money for the Rest of Us Plus, there. I'd like to thank FilterBuy for sponsoring this week's show. Spring is in full swing, and if you haven't already, you might want to change your air filter. Luckily, FilterBuy offers a wide selection of high-quality air filters in every MERV rating with over 500 different sizes of filters. So you're sure to find a filter for your HVAC unit. And now for a limited time, as I mentioned, get 10% off when you go to filterbuy.com/David. Everything I've shared with you in this episode has been for general education only. I've not considered your specific risk profile. I've not provided investment advice. Simply general education on money, investing, the economy. Have a great week.